Here's a number that should terrify you: 80%. That's how many universal life insurance policies sold in Canada don't actually meet the buyer's needs. And here's why. Agents are selling $500,000 universal life policies to families earning $60,000 a year, asking them to give up 5 to 10% of their income annually. These policies are often underfunded, based on unrealistic assumptions, and rarely kept long-term. Could families be buying peace of mind now, only to face financial regret later? If you've ever been pitched universal life insurance that builds wealth, what I'm about to show you could save your family from financial ruin. In 2023, Ontario insurance regulators dropped a bombshell. After investigating 130 agents, they hit 65 agents with enforcement actions for what they called practices that are extremely harmful to consumers. What were these agents selling? Primarily, universal life. 80% of the files did not demonstrate that UL policies sold were aligned with customers' needs or circumstances. But what's even more shocking is 75% of universal life buyers were young people in their 20s and 30s with no dependents and modest incomes, exactly the wrong demographic for complex investment insurance hybrids. Agents skipped simple, affordable, permanent coverage and jumped straight to the most expensive, complex product available. This wasn't isolated misconduct. It's an industry-wide pattern. Regulators have identified long-standing issues with selling universal life policies, some of which may have persisted for years. Universal life insurance, UL, launched in 1979 thanks to E.F. Hutton, one of Wall Street's biggest brokerage firms at the time. It was meant to be flexible and modern, built for a high-interest rate world, and to be the perfect solution. Life insurance plus tax-free investing. Overall, UL was meant to give people the power to adjust premiums, change death benefits, and grow cash inside the policy. By the mid-1980s, Canadian insurers were selling it, especially to high-net-worth clients seeking flexible estate and tax planning tools. But beneath the surface, there was a design flaw still causing trouble. Today, most universal life UL policies are structured using yearly renewable term YRT cost of insurance. The insurance charges in these policies start low, but don't stay that way. As you get older, the cost of coverage rises significantly. At age 35, you might pay around $40 a month for every $100,000 of coverage. But by age 45, that cost can jump to $125, then $350 by age 55, and over $2,000 a month by the time you hit 75. And that's just for the insurance portion, before you even add admin fees or savings components. If the policy isn't properly funded from the start, it can quickly become unaffordable later in life. Why buy it? Because advisors show dazzling projections, high interest rates, strong investment growth. Cash value would cover rising costs, right? Wrong. When interest rates and market returns fell and stayed low, those projections collapsed. Investment accounts underperformed while charges kept rising. Many Canadians faced premium shock in their 60s or 70s, a huge bill just to keep their policy alive. This isn't history. It's happening now as older policies hit their breaking point. People thought they had lifelong coverage, but costs are devouring their savings. The fallout led to lawsuits, reforms, and an industry rethink. UL still has its place, if appropriately funded and actively managed, but more people are turning to whole life insurance. Nearly 70% of Canada's life insurance market today is whole life insurance, while universal life makes up just 10% of premiums, with the remaining 20% going to term policies. Why is whole life so popular? Whole life plays it straight. Insurance cost is locked in from day one. Premiums never increase. Cash value grows every year, guaranteed. No surprises. No premium shock. No worrying if interest rates tank your policy at 72. So let's break down whole life versus universal life, going over what advisors don. Whole life insurance is steady and predictable. Premiums stay the same for life, whether you're 30 or 80. It builds guaranteed cash value every year, no matter how markets perform. No surprises, no premium spikes, no constant monitoring. It's not flashy. but it's reliable. Universal life is more complex. Premiums start low but can rise sharply with age, sometimes by thousands. You carry the investment risk and have to actively manage the policy. If underfunded or unmanaged, it can quietly lapse, leaving you with nothing. For many Canadians, especially those wanting permanent coverage, tax-advantaged growth, or estate planning, it's the smarter long-term move. Universal life was built on big ideas: flexibility, growth, control. But too often, those promises depended on assumptions that didn't hold up. Don't let your family become another universal life horror story. Visit policyadvisor.com or call us today for a free consultation. We'll show you how whole life's guarantees beat universal life's gambles every time.